I wanted to cover today, thanks, William, for recording, and we can send this out, Joel, maybe to the rest of the group. I wanted to cover today investment properties. And the reason why I wanted to cover this is because I am being asked by my own clients more and more about investment properties. And I don't know exactly why. I mean, I have kind of a hypothesis. The stock market is high. I think people are maybe less inclined to put money into the market right now. Also, a lot of savvy investors are thinking mortgage interest rates are going to fall. And if that happens, home prices could increase, which makes it a good time to buy now. And if they're buying an investment property, they're thinking, okay, maybe I can then refinance, and then all of a sudden the property cash flows. So I personally have been getting more and more inquiries from clients about buying an investment property. Another reason is just maybe clients are less likely to buy new primary residence, just given if they've locked into a low rate. And so I wanted to go over just a couple things with investment properties. The first thing is when people hear investment properties, sometimes I find real estate agents will immediately jump to alternative underwriting, which certainly exists with investment properties. But I have done hundreds of investment properties under conforming guidelines. And so let's just kind of go over a conforming investment property loan and talk about how that works. Because the reality is, if the client can qualify for a conforming loan on an investment property, that's going to be much more beneficial for the client to do the mortgage that way than it is to go through an alternative underwriting. So the first things first, so I kind of have like a framework. Whenever I get an inquiry for an investment property, first things first is I want to see if we can get this done through conforming. Because that's really going to be best for the client, and it's also going to make the mortgage process pretty seamless. Like, as everyone knows, we're partnered with Rocket. They're able to process these loans very, very fast. So I'm going to share my screen here and just kind of walk you through that framework. So I get an investment property inquiry. First, let's take a look to see if we can get it done conforming. Now, the first thing I'll ask is, what how many finance properties they have, because there is a limitation. You can only have 10 finance properties under Fannie Mae guidelines. Now, if assuming they're under that amount, then we're okay. So we're good to go there. So we can start kind of running the numbers here. So most people inquire, say, hey, I want to do an investment property, $500,000 purchase price, 20% down. I want to put the minimum down. And again, I'm getting more and more of these inquiries, I think, because the stock market's high, people are sitting on cash, people don't want to move out of their existing primary, and savvy investors are thinking rates are going to go down. So that's my thesis for it. So let's just say it's a great borrower. And we don't really care about the income at this point because we just want to see the rates on what it would be. So we'll just say it's in California, and it's a $500,000 purchase price with a $400,000 loan amount, so it's 20% down. And it's an investment property. Let's just say it's a single-family home. So you see this on the right-hand side. We're saving that. Okay, we don't care about the insurance and taxes at this point. It's not a first-time home buyer. It's an investment property. Okay, and we're going to just run the numbers here. Now, first thing you'll notice on an investment property is that the rates are higher relative to a primary residence. And so you can see here, today's rate 7.375, let's say has 2 points. And so you can present this option. What I will often do is, because many borrowers want to buy with just 20% down, is I will run the analysis on a conforming loan if you put 20% down versus 25%. Again, when you're dealing with a client who's buying an investment property, it's a little bit different. There's not as much emotion involved, and it's more about the figures. Like, this client has an opportunity cost. They could just take this money and put it in the stock market, or they could do that. It's like, they're not living in the property. They don't care, like, this isn't impacting which schools their kids go to. It's a very different transaction. Just think about it from the client side. And while the mortgage is kind of the same on our part, we have to put ourselves in the shoes of our client. So I'll say, okay, well, Mr. and Mrs. Client, you're looking at 7375, and that's going to have origination points of 7668. Now that's at 20% down. And what I'll often educate them is that, hey, if you were to just put it a little bit more down, it's going to have a big impact on a positive impact on the interest rate. So if they put 25K more down, so in this case 5% more, and it's a 375 loan amount, now let's run the numbers on the investment property. So that same 7.375 rate now only has 1192 points. And so again, we're dealing with a savvy customer. So the way that I often will frame this is I'll get a calculator out and say, okay, your savings by putting an extra 5% down is 7668 minus 1192 is $6,476. So on a $25,000 basically investment, you immediately net $6,475. It's an incredible investment if you think about it that way. And again, we're dealing with savvier borrowers here. So essentially, then they only have to put an extra $18,524 down because the fees are being reduced by the $6,400. And usually, when I present it that way, they're like, "Okay, makes sense. Let me do the 25% down." Now you might be thinking, "Okay, this is great, Joe, but what if I have a client who wants to buy an investment property, but they don't have a whole lot of cash?" Well, you have to take into account their client's primary residence. So assuming they own their primary residence, which it doesn't necessarily have to be the case, you can have potentially a first-time home buyer buying an investment property. It's a very rare situation, but it does happen. You will assess how much equity they have in the property. And so potentially a client can actually use the equity in their existing primary residence for the down payment. That is an acceptable source of funds for the investment property. So we can just stick with Rocket. Now we work with a few different home equity providers and they're welcome to go through their bank, but let's just kind of stick with Rocket. So we got the same situation. So we got 500,000 and it's 125K down. Let's say the client only has 25K in the bank, but they uncover this investment opportunity. So then I'm going to assess their primary residence. So let's create another scenario. Okay. And let's say their primary residence, and again, we don't care about the income at this point. We just want to see what the rates are. So I'm going to do a cash out, and I'm going to do a home equity loan, and I'm going to, let's just say hypothetically, their first mortgage balance is 500,000, and let's say their property value is 900,000, so they're sitting on 400K in equity, and let's say they want to do a $100,000 loan. So now they're getting 100K cash out. Okay. And now this is a primary residence, and so they're taking some cash out. And so you can run the numbers here on a 20-year loan. So here they can take cash out. Let's say you could do like an 8.9% cash out, and now they're accessing their equity. And again, we have other HELOC lenders, so you're welcome to shop around for this. So you're accessing their equity here of 8.9%. So this is and what I always suggest is like you can apply for this loan and make it contingent, right? So let's say you have a client who wants to buy an investment property. Well, they probably don't want to take out this loan unless they go into contract and like they know they're going to close on the investment property. Well, you can set this loan up and then have the closing occur, basically a week before the closing on the investment property. So I just had this actually a couple months ago. So client was using their home equity loan they didn't have quite enough to get to 25% down. So we did a pretty small home equity loan, but it was fast, and we set it up. once they were in contract, then we closed on the home equity loan, and then we just used that as the source of funds. So again, going back to what I led with, if I'm dealing with a client who wants to buy an investment property, sometimes I find their agents are immediately pushing them into alternative underwriting, but I always want to see first, can we get this loan done on a conforming loan, because it's going to best serve the client. You can get a fixed rate, lock that rate in, less fees than an investment property. Next thing I want to bring up is sometimes clients think a multifamily purchase is an investment property, and there can be a misconception. And so if, as long as the client is occupying one of the units, then that is considered a primary residence. One of the things that I don't think the agents and loan officers have done a good enough job marketing towards is the change that occurred, I think it was a few months ago, where Fannie Mae now allows for 5% down on multi-unit. Now this is restricted to the conforming loan limit, so let me look it up. So you can't do high balance. Let's take a look at the conforming loan limits. So on a oops. So on a 4-unit property, that's 1.4 million. So let's just run the numbers here. Let's just look up Fresno zip code, where you can probably get a 4-unit within 1.4, 93650. 93650. All right, so we're going to do conventional. We're going to say it's 1.5, oops, not 15 million. It's 5% down. We're going to keep this as a primary. We're going to change it into multi-unit, 4 units. Okay. You can say the client's a first-time home buyer. All right, let's see what kind of numbers we get. So this is a big change. This used to be a 25% down payment to do a 4-unit property on a conventional. So now they can get this same client, and I find that sometimes borrowers think, oh, this is going to be an investment property because I'm going to rent out 3 of the units. I'm like, no, as long as you intend to occupy one of the units within 60 days of purchasing the loan, purchasing the property, this is a primary residence. Now, my radar always goes up for occupancy fraud whenever it's a multi-unit, especially if someone lives in a single family home that they own. It's usually unlikely that someone moves from a single family home into a multi-unit, but there could be situations where it does. Or I think this is a perfect program for someone who is maybe not in the family formation stage, or maybe they don't have children, and it's an opportunity to get into a property for a very long-term investment with a low down payment. So I think of kind of like higher income, lower asset, like I think there's a term like Henry's, high income, not rich yet. So essentially they can do basically in this case, 699, they're locking in the 30-year fix. The PMI is dirt cheap, like when you think about this as a factor of the loan amount. It may look high, 593, but think about this from an interest rate standpoint. So they're putting 5% down, right? So they're paying 593 in PMI. So if you want to think about this, and again, you're dealing with a more savvy investor, they're essentially borrowing an extra 15%. So on a $1.5 million home, 15% is $225,000. So basically, in return for borrowing an additional $225,000, they're paying an extra $594 a month. Okay, well, think about it this way. Right now, savings accounts, like I have Apple Savings, are paying 4.4%. So let's say they had the money and they kept the $225,000 in their bank account. Well, they could earn a risk-free 4.4%. So the 4.4% is on 225,000 is $9,900 a month. I mean, sorry, $9,900 a year. That's $825 a month. $825 is greater than the $594. So it's almost like a financial arbitrage right now, given where savings, given that savings rates are now paying over 4%, and then you have PMI for people with excellent credit is so cheap, it almost doesn't make sense to put more than 5% down. There's a financial arbitrage opportunity. And so, depending on the sophistication of the borrower, I explain that to them, because again, there's always like, you have to put yourself in the client situation. Like, oh, I'm paying $600 a month. Yeah, but you're not putting 225K down. So that means you can earn $825 a month on interest on that. So basically your interest pays for the PMI, plus you are left over with 200 something dollars. So again, financial arbitrage. So I do think that this product has legs and it's not being marketed well. And I did just want to share that as I go over investment properties, because sometimes I get calls from borrowers who are buying a multi-unit property, and when they do the application, they're actually classifying it as an investment property, whereas if they were to occupy one of the units with the intention of renting out any of the other units, then that is considered a primary residence. Next item I want to go to is again on investment property. So let's say you got a client and they cannot qualify under conforming, and we've looked at all angles, because I really want to exhaust that before we go to alternative underwriting. Well, now you could do what's called a DSCR loan. I should have a worksheet here, but I don't. But I actually just came across this lender, which I really like their DSCR product, and so we're going to kind of learn together here while I bring it up. Because you can learn a lot just from lenders' websites. So I want to go into their DSCR loan, and this stands for debt service coverage ratio. So here you go. You can see minimum credit score 575. So let's say that would be a reason why someone would not qualify for a conforming loan if they have a low credit score, but they can still potentially do this. Loan amounts up to 3 million. That's another potential reason. Maybe the loan amount's too high. Single family homes, non-warrantable condos. That would be another reason. So non-warrantable condos are when the condo is not eligible to be delivered to Fannie Mae or Freddie Mac, meaning it's not warrantable. Therefore, it requires a private marketplace solution. This is for non-owner occupied, and no income or job verification, no prepay options available, and this has to do with how we as the broker get compensated. But one of the reasons why I like this lender is they will actually allow, so what comes up sometimes is you have first-time home buyers buying an investment property. So I mentioned to you that this is rare, but it does happen. And so it's a little bit complicated under conforming, because we have to like get the debt of like the rental income or things like that. And I think they also have to buy like away from their certain distance, or there's some rules around it when they're a first-time home buyer. But with ACRA, you can buy that first-time home buyer, and it's a way for basically clients to get into the door of owning the home while putting 20% down and structuring it as an investment property. And I think as long as they intend to rent it, and maybe they rent it within the first year or so, what happens after that, I don't think ACRA really cares, as long as they get compensated. So it is a way for somebody who cannot qualify for a primary residence purchase to own a home, continue renting their existing property for a little bit, but at some point potentially they could move into the property and refinance the mortgage. So that's one of the reasons why I like ACRA. Next product I want to go to on investment is all of these programs that I went over, conforming, DSCR. This is assuming that the property, the collateral itself, is in good shape. Now, what if you got a property that's in disarray and needs repair? It's not livable. That loan is not eligible under Fannie Mae or under the DSCR. So you need to get, oh, nice, Joel. We need to get approved. Joel, I don't know if anyone can see the chat, but Joel just added that ACRA is an approved lender of ours. And one of the reasons why I like ACRA, because there's a lot of non-QM lenders out there, but one of the reasons why I like them is they're actually backed by a hedge fund. So when they make the loan, they're actually making the money out of their own pool of cash, whereas most of the non-QM lenders, they're really kind of just a marketing company. They will do the loan, but they're looking for other sources of cash that will then vet the loan, as the investor requirement. So you send the loan to them, they're talking to the investor, whereas ACRA, it's kind of like their own money at stake. So there's very few non-QM lenders where it's their own money at stake, and that's one of the reasons why I like them. Okay, so then if it's in disrepair, you can do a rehab, and one of the programs you can do is like a fix and flip loan. So there's a few different lenders that we work with on fix and flip. This ULand Lending is one of them, where basically you buy the property, and they have a nice kind of rate widget, but you can basically buy the property, you can get a loan term, and let's say it's a 12 months, you go in, you fix the property up, because sometimes the seller is unwilling to do the repairs to make the property eligible, for Fannie Mae, Freddie Mac. There might be reasons for that. Sometimes, they just don't want to put money into it, whatever it might be. So there you got to do kind of like a rehab fix and flip. And this could be a way for the client to basically put the 20% down, get some cash for the rehab aftermarket, and then they could either refinance into a long-term mortgage, or they can end up selling it, fix and flip. If somebody is really good at construction and cosmetic, fix and flip can be a quite lucrative business. So that is investment property solutions. To recap, we've got just conforming. Again, I feel like that often borrowers can sometimes get a conforming loan and they don't even go that direction. And this could be for a few reasons, like the DSCR is an easier loan, but it's not as favorable financing terms. You have multifamily, where as long as they're occupying the property in one of the units, it's technically a primary residence. You have the DSCR loan, debt service coverage ratio, where, hey, you put the down payment, we don't collect income, you're good. If the property is in disrepair, appraiser's going to call out things that need to be completed for the appraisal to be done. Then you want to look at some sort of construction fix and flip type program. And lastly, I want to go over buy before you sell. And again, this seems just sharing kind of I like to, whenever I do these market updates, I like to just share the conversations that I'm having presently. And this is happening more and more, where clients have this very low rate on their primary residence, and then they want to buy a new primary residence, but they're thinking, what am I going to do with my existing primary? And it's a little bit harder for them to stomach, because they might be going from a 2.75% rate on that primary to 6.75 on the new primary. And what I like to present is the option of converting your primary residence into a rental. So I just did this on a transaction. It was a little tricky, but let me just walk through how this works. So you're buying a new primary residence. Now, first things you want to think about is, okay, where's the source of the down payment? Now, again, they currently occupy an existing property as a primary residence. So if they need to set up a home equity line of credit to create funds for the new purchase, let's say their intention is to rent it out, you can set that up. So now let's say it's let's use bigger numbers. So let's say they want to buy a $2 million purchase price, and we'll just run the numbers on this. They want to buy a $2 million purchase price, and I'm sorry, we're butting up against time, so I'm going to just be real quick here. So they want to go $2 million purchase price on the new one, but they don't have 400K in the bank. Okay, maybe they got 200K in the bank. Okay, so down payment 20%, 400K. So then what that client can do is set up a home equity line of credit on a new purchase. Okay, it's on their existing, and tap into that. That is an acceptable source of funds. Now, how do you deal with converting the primary into the rental? Here's what the underwriter is going to want to see. In order to, you can use 75% of the anticipated rental income from the departing primary residence. And this is determined by a lease agreement. Now, the lease agreement can be signed by everyone. I think this is kind of like I didn't set the rules, but so this is what Fannie Mae came up with, because ultimately, like, the lease agreement can be signed by anyone, and who can really get a lease agreement so fast? But that's what they do require. They need to see a lease agreement, and they need to see the security deposit. So the client will go get a lease agreement. Let's say they're renting out their $1 million property and they're moving to a $2 million property. Let's say the $1 million property is going to have a rent of $6,000. Well, you can use 75% of the anticipated rental income, so that would be $4,500, to offset the mortgage payment that's tied to that property, to their departing primary. And in some cases, depending on the balance, depending on how much they can rent it for, you could potentially get, that 75% of the anticipated rental income could really just offset that payment altogether. So now they're freed up to go and qualify for the new loan, or it might be a small differential. So let's say if it's $4,500, the anticipated rental income, their principal, interest, taxes, and insurance monthly payment is, let's say, $4,750. Well, now you have an extra $250 liability. Not much. And it's amazing, like, how many clients can actually qualify on converting their primary into rental. And we can run through kind of a jumbo numbers. Now you're looking like at a 6.75 on a new jumbo. And then so they basically just have to qualify for this mortgage. Here's why I like this program. Number one is, let's say they really want to keep this as a long-term rental. The advantage is they retain that low interest rate. We have clients who have a freaking 2.25 30-year fix. So like, that's like a big time opportunity not to get rid of that, and you just convert that into a long-term rental. And once the mortgage is paid off, wow, big upside on the investment. Second reason why I like it is there is bridge loans, buy before you sell lenders, where basically they unlock some of your equity, but they create a purchase agreement on your existing primary. So like HomeLight is one of them. I've partnered with them before in deals. But there's fees involved, a lot of fees. Like, you could end up paying $30,000 depending on the size of how much you're unlocking. And so this is essentially a way to do buy before you sell. Let's say your intention is to actually sell the property at some point. It is a way to get around that and to do buy before you sell with no additional fees. So if the client can even if they want to look at that HomeLight solution, they should still see, oh, well, maybe I should do conversion into a rental property, my existing primary, because then I'm going to save on the fees. Because if their intent is to sell, often, as you guys know, when they buy that new primary, the seller of that property may not want to have the contingency of the sale. So just something I wanted to bring up. I'm always happy to chat, but I think you're going to encounter this situation a lot. People who have low rates on their existing primary, they're like, hey, we've been here for 5 years, 10 years. We want to move into a new home. What should we do? How do we unlock the equity? What are our options? And I like to just kind of go through basically 3 options. And again, I'm going a little bit over. One is converting into the primary into a rental. And I swear I have talked people into this, and they thank me later on. And especially they thank me if, if it ends up being like a good rental for them. because they don't even think that's an option, and sometimes the agent is not even presenting that as an option. 2 is they can make it contingent. So let's say you own $1 million property with 500K in equity. You're buying a $2 million property, and you want to just transfer that 500K right into the sale. Well, you can do that, but it's got to be contingent. And I've done those before too, but it can be challenging in a competitive market when you make that offer on the $2 million property, saying, hey, this is also contingent on us selling our existing primary. And then 3 is the buy before you sell, where you unlock some of your equity. We've partnered with a company called HomeLight. There's a whole bunch of fintechs that have kind of tapped into this space, you know, often you're not really making much money off it. You're just kind of basically facilitating it for your client. So I will pause there. Any questions? I know we've gone over.
We'll partner with ULAN for fix and flip.
Yeah.
We'll partner with them. Okay. And then the 25% rule you were saying about the investment, is that the same for primary residence? Does it make a difference from 20% to 25 to lower the rate or the origination fees?
It doesn't make as big of a difference on the pricing. So if you can see here, you see how these have these pricing adjustments. So I encourage you to kind of just play around with this so you can see what it would be. So let's say if you have a client here and they put 20% down and it's conventional, and this is straight from Fannie Mae. So basically Fannie Mae has an LTV FICO box. So like the lower the LTV, the higher the FICO, the less the adjustment. And then there was this, like, it was about a year ago, there was all these big news because they changed they changed the pricing adjustments for lower credit scores. So a lot of like right-wing media publications like, oh, we're making it so that you benefit from having a lower credit score, which isn't really true. But all right, so you can see here, you have the adjustment here. So you can see how it says 75.01 to 80, right? It has a 0.375 adjustment. You seeing that, Ricardo?
I think you stopped sharing your screen. Hold on.
Oh, okay, thanks. All right, so to recap, I did a 500K purchase price, 400K loan amount, 20% down.
Yeah.
Okay, 500K, 400K. And so you can see the pricing adjustments. Okay, you see that pricing adjustment from 75.80, 75.01 LTV to 80 LTV.
Oh, I see. Yeah.
Yeah. Okay, so now let's see what it would be at 75. So it's 0.375. So you can see now it went away. So you're saving 0.375% on the adjustment. So on a $375,000 loan, or actually it'd be more, 400,000 times 0.375% is $1,500. So you save $1,500. Now,
so if they have 25%, I mean, they're thinking about putting 20% down. If they have 25%, just go for the 25. Save some money.
well, it depends on how much they value that 25K versus the saving of the 1,500K. You know, different people have, you know, because keep in mind, maybe they want that 25K in the stock market or whatever.
Yeah.
So it just depends on the scenario. But I want to point out, if this is an investment property, how big of a difference in pricing. So it's a 0.375 difference on a primary. Now we're going to run the same on an investment. So always be mindful of these adjustments, because this kind of dictates, you know, where things would be. So you can see here on investment property, 70 to 70.01 to 75, the adjustment is 2.125. You see on that?
Yeah.
Okay. All right. Now we're going to run it at 80%. So And also, like, just something to know, like the LTV, once you hit 60% LTV, there's really no benefit to going more. A lot of people don't realize that. So now you can see there's two adjustments. There's the 3.375 plus the 0.375. So you got 3.375 plus the 0.375. So now that you got 3.75 minus the 2.125. So the difference in pricing on the adjustments of on an investment property between that extra 5% is 1.625%.
So it moves it more on an investment than it does on a primary, that 5%.
Big time. Huge.
Okay, I see.
This is why I kind of led off is I talk to so many clients, they're like, oh, I want to put the minimum down. I want to put 20% down. I'm like, well, do you really? Let's run the numbers for you. You know, if you can put an extra 25K down and save $7,000,
Yeah,
think about
yeah.
your return on investment on that. You know, you just and plus it's not like you're like, you know, burning the 25K. Now you own more of your home. You immediately, you know, got a return, an immediate return of you know, like 28% on your money immediately. So you know, average stock market return is usually around 7 or 8%.
Yeah. Oh, that's good. Good info.
Yeah, exactly. So be mindful of these adjustments. They're there for a reason, for us to learn all the, you know, tricks of the trade. So like here, I'll give you another example, since, you know, we it's just kind of the mortgage group at this time, so I don't mind going over. If you do 60, so you can compare how that is. And again, these are just straight from Fannie Mae, and we're running it through the pricing calculator. But you could actually go see the. Sorry, I probably should have continued. We can go see the rate sheet. Let's see what. Where's the rate sheet? Rate sheet. I should know this. I should know this. Actually, it's in the pricing. So like when I was starting my career as a loan originator, these pricing calculators didn't exist. You just get this rate sheet, and then you have to calculate the rate and the pricing, and you probably make a mistake, you know, sometimes, because you're like having to put all these adjustments in. So you have conventional rates and pricing, and then you can go to the LTV FICO adjustments. Now let me zoom in a little bit. Can you see this okay? You see this okay? Hello, Ricardo?
Yeah.
Okay.
Yeah.
Are you see how there's these adjustments here? So you learn like where the break points. So this is the FICO LTV adjustments, right? So you can see basically it doesn't matter what your credit score is. With the LTV is below 30%, it's the same rates for everyone. You can have a 639 credit score, and you're getting the same as a 780 credit score. And then you can see here the adjustments, and so you can see how this kind of plays out for the, you know, for the FICO adjustment. So the lower the credit score, the higher the LTV, the bigger the adjustments. You know, like if you got a 639 credit score, you're going to hit a 2.75% adjustment, even on an 80% LTV. So if this is your client, what would you advise here?
Hi, Jeffrey. Never sent this tax one. I just letting you know, yes,
Yeah.
Sorry,
Let's say you got a 637 credit score client, and they're putting 10% down, and they're going to come across, which means they're going to have a 2.625% adjustment. What would you advise here?
To put more down, right?
They don't have more down. Any other thoughts?
Oh, I don't know.
They don't want this 2.65 adjustment. And this doesn't even include our comp. So, you throw in like a 1% comp on our point. Now all of a sudden they're having to take like a high sevens rate to cover all these adjustments. Any suggestions on what to do? Are there other programs?
So, you were saying the other lenders, right? That we can go with. Wait, but they only
Other lender.
they only
This is
have
all from
10%.
Fannie Mae. So this isn't like this is going to be across all. This is Fannie Mae, Freddie Mac adjustment. So it's going to be across lenders.
So what were your suggestion then? If they only have 10%, it's at 6, whatever. They don't have that good credit.
Yeah.
So how are we making softening the movement of the rate?
Well, maybe they want to look at a different loan program, like FHA. Now FHA, you could go to their
580,
adjustments. Now and say, oh,
what are
what's
the rates
this?
for FHA though? Like, are they like they're lower, right? No.
Yeah. So you can see here the government FICO adjustments. Look, it's much less. Like that same 639 client, it's only a 1.25% adjustment on that. Or that's VA. Sorry, this is FHA. So FHA 0.650, only a 0.650 adjustment. So a 639 client is almost getting like basically the same rate as an 800 credit score client, except it's like 0.65 is a pretty small differentiator, much smaller than on conventional. So the rates don't change as much for FHA clients based on credit score relative to how they do on conventional. Conventional, you get penalized if really like severely if you have a lower credit score.
So what's the dinger for FHA then? What's the dinger that will
I just went through it. So we say the adjustment's 0.65 FHA. And so then you could go, and again, we're pricing this out on the rate sheet, but it's much easier to do this on the pricing calculator. But somehow knowing where these things come from is a good thing. So now all of a sudden, that client can get basically a 6.125 relative as opposed to like a 799. And so you can see how this manifests itself in loan. So let's just do all options. Ricardo, what's your zip code?
95963.
95963.
It's cheap, so it's not really.
There's nothing cheap in California anymore. So we're just going to keep all the loan types available. We'll say it's a $400,000 purchase price with a 10% down. Okay. We'll say it's client paid PMI. We'll say it's lender paid comp. Okay. We're going to finance upfront MFB, primary single family.
Sorry,
That's all good. So we're going to look at conforming versus FHA, side by side. You following me?
Okay.
Now look at the adjustments here. Because that credit score is really low, 639, Fannie Mae has that 2.625% adjustment, whereas the FHA, it's only a 0.65 adjustment off like the top tier. So big, almost 2% difference. And so that manifests itself. You can see also here the mortgage insurance is more expensive under conventional than it is under FHA. So you can see here under FHA, closest rate to no points is 6.49%. That's the closest one to no points. Closest one to no points is, well, it would be this 7.5. You can see that the payment in the MI is so high. So, you have clients that sometimes will ask for a conventional loan, but when you get their situation, FHA is maybe a much better option. My general rule, very, 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 very general. If you have a 680 credit score, or if you have a 680 below 680 credit score, you should almost always be thinking FHA. If you have above 680, even then you still may want to go with FHA versus conventional, but then you're thinking maybe more likely conventional.
Okay.
That's a very general rule, though.
Alright.
There's circumstances that would maybe make it, to offset that, but the lower the credit score, the more they benefit from FHA.
FHA follows conforming too, conforming loan limits, same thing, same.
Nope, they have their own loan limits.
Okay.
So you can go FHA loan limits. What county are you in?
Glenn.
Glenn?
Yeah.
All right, so for a single family, $498,257. So conforming, it's 766. You can see here for a 4-unit, it'd go up to almost $1 million, 958.
Okay.
So if you know anybody who has a 620 credit score and they want to buy a home for less than $5 million, FHA, they can buy 3.5% down, get a really low PMI, or it's not even PMI, it's government mortgage insurance. It's mortgage insurance, MIP, and that client would be better served going FHA. All right. So let's pause there. Thanks everyone for tuning in, and I'm certainly around if you have any questions.
Sounds good. Thank you, Joe.
All right. Thanks, guys.